When we were planning today's session, we were saying, is it going to be debt versus equity or debt and equity or capital and control? What do we call this? And I think the reason we wanted to do this session is because this is such an important conversation for brands. Frankly, and you're on the front line with a lot of brands. Talk about what from the point of view of brands and their funding and what they're looking for, and then the kind of decisions they have to take internally and the issues they have to work through that they may never have thought about before.
Yeah, funding is such an important part of the success of the businesses we work with, and I'm sure the businesses that Piper invest in. And there's various paths that these businesses can take, and I wouldn't say there's one path for all. There's different considerations, pros, cons to raising equity versus being VC-backed or PE-backed versus bootstrapping. And for the customers we work with, we support everything from VC-backed businesses through to bootstrapped, or the other way around, I should say, but everything in between. And so we see a bit of everything, and really kind of what we're doing is helping businesses be capital efficient. And whatever kind of funding situation they're in, we want to make that work as hard as it possibly can.
Great. And Lizzie, what sort of funding scenarios do you see in the brands you're talking to? I suppose they're probably coming to you maybe at a slightly later stage than they might be coming to Triffin, or there's probably some overlap there.
Yeah, so we come in at that sort of 5 million revenue as a very earliest point, so probably a tiny bit later than where you guys start.
But you have brands going up to 20 million, don't you, in the portfolio?
Absolutely,
Yeah, I do think in 25 it is probably more of a challenging equity raising scenario than maybe in previous years. I think there's still some uncertainty in the market, or some more sector agnostic investors have come away and out of consumer. So I do think it makes it a tiny bit more challenging, and maybe that's a good thing that brands are looking where else actually can they get that capital from. And I do think there's definitely a gap in the early stage equity market for consumer. There's loads of B2B tech investors that come in at that really early stage. So a very short list of consumer investors that actually come in at that point.
And what sort of misconceptions do you see from brands when they're thinking about what options they have for funding?
I think many brands think they have to raise equity.
Yeah.
And obviously when starting out right at the beginning, most businesses need some kind of seed capital, and people sometimes raise friends and family rounds, that kind of thing. But I think a lot of businesses feel like they have to raise decent amounts of equity finance, either via VCs or get some PE backing as they go later. And I think it's amazing how far you can go almost without funding. I think there's definitely a time when you want to, I think, maybe take a model that's working very well and then start to expand more quickly. And I'm sure they're the kind of opportunities that, that Piper look for. But some of the fastest growing businesses on our platform, some of the most profitable businesses on our platform, are those that are really bootstrapped, haven't raised any money. And they're super lean, super agile, and really impressive businesses. And they haven't needed the funding that other businesses have needed maybe in the past to get to the stage they get to.
I love those types of rounds where they've done that really leanly and really cleverly in their bedroom. Do you see it, or starting often from, say, bedrooms or their kitchens and then growing out, do you see a shift in kind of the approach of founders in terms of whether or not they believe they can bootstrap, or whether they all feel they still need to go for a big equity raise?
I think we see such a mix. So we do see brands come to us that haven't done a fundraise, that have got to that 10, 20 million pound mark. And I think that's super impressive. I'd say that's probably still on the rarer side.
Do you think it takes an unusual type of person to achieve that?
I think definitely a disciplined person.
Okay.
Every single penny needs to count. Every single digital marketing campaign that you do has to count. There's no sort of leverage for testing and going wrong, really. And maybe it sometimes takes a slightly longer period of time. Maybe that's not as attractive to VCs, but Piper, we're a bit more sustainable growth, a bit more steady. So that's definitely not something that would put us off when we're looking and assessing a company.
Okay, so we're going to talk about the two different types of funding: debt, equity, the pros and cons of both. Should we start with debt, Franklin, and you?
Sure, yeah. Debt
is such a controversial word, isn't it, in terms of people. Some people understand, some people react negatively. Just talk about the landscape and when it's good and when it's not so good for brands.
Yeah, so I guess the first thing is that it is a broad landscape. If you think about the debt and credit products available at various stages of the life cycle of a company, they can vary significantly. You have everything from credit cards and traditional bank loans to bigger bank facilities, various types of revenue-based finance, invoice finance, inventory finance, and the list continues going on and on. So it's not surprising it's actually quite a challenging landscape to navigate. And if that's not really your background and you're having things thrown at you
Because brands are having things thrown at them, aren't they, from in terms of offers of debt funding?
Absolutely, a combination of when you start hitting certain, let's say, thresholds, you'll have sales teams selling you financial products, you'll have probably emails from PayPal or Shopify and other kind of companies making money available to you. Yeah, more options available as you grow, harder to navigate, I think, those options if, again, you're not really kind of experienced in them. And even to compare actual costs of capital, align them to very specific use cases. The best finance operators in the industry do this very well. And for sure, we see the most successful businesses leveraging debt and credit really efficiently, really well. And that can be something which helps them grow faster. In some cases, can actually increase profitability as well. I can speak about that. But yeah, it's something which to a lot of founders and early stage businesses is a bit of an unknown. Yeah.
And you've talked about good debt and bad debt. How do you categorize those two?
Yeah, I'd say rather than just like straight kind of good and bad debt, I'd say it's more like how it's applied.
Yeah.
So starting with the bad, I think if you're a business that isn't profitable and you're borrowing money to really cover up gaps in profitability, that can be quite dangerous. And many of the businesses that talk about debt spirals and these kind of things, it's usually something related to that, where they're actually using debt for the wrong use case to actually cover up inefficiencies in trading or inefficiencies in their profitability.
And that's what is likely to lead to a debt spiral.
Yeah, absolutely. And if you think about some of the products that may be available to those businesses, for example, revenue-based finance, where they're taking a percentage of your daily sales, you could have a business that is, maybe struggling or would struggle to repay those products in traditional terms, but because it's now available in a different structure, it can be available to them, but not always the best thing for the business. So that's an example of where I'd say debt is used in a negative way. And maybe what creates some of the negative stories in the market, why people are fearful of it. On the other side, I'd say that when we see debt leveraged extremely efficiently, it's where it's really addressing the need to grow quicker. And that could be something as simple as expanding a retail and wholesale channel where there's demand for their products. Obviously, to grow retail and wholesale partners requires an upfront inventory cost. You have longer payment terms with the customers you'll be working with. And so that's the kind of, I'd say, use case where debt can be used very effectively. Also, if you have a lot of confidence in some of your core products and really looking to increase the amount of inventory you're borrowing, and obviously to grow, you need to buy more inventory and to spend more on marketing. But if you have just some confidence in those products and the price at which you can acquire customers, if you're profitable on first transaction, these kind of things, there's a way that debt can be leveraged to perhaps bulk purchase inventory and reduce your cost per unit. And that's where you can actually use debt to increase profitability. We've actually built tools to help businesses do this. So as well as making capital more accessible to our customers, which has been our mission really, we built tools to help them make informed decisions. And so that will be understanding things like fully financed cost per unit after taking debt to buy inventory, and understand the ideal length of term based on their inventory production lead times, based on their payment terms with their suppliers, and then based on their cash conversion cycles if they are a multi-channel business. Yes, so we're not just trying to make it available, we're trying to actually help businesses make the right decisions and access the right types of capital.
And I can definitely vouch that you do that as a company, because obviously we know a lot of brands, and I know a lot of brands that are on your platform.
We do, yeah.
And a few have said, have got themselves into revenue-based finance lending cycles, and then they've told me how you and your team have had to wean them off it. And they're very grateful for that.
Yeah, I mean,
even though it's like a process, they know what's happening. They're very grateful.
Yeah, I'd just say for the past 2 years, we've just seen consistent bad experiences with all kinds of solutions in the market. And that's everything from big banks whose products can be inaccessible and can be extremely painful and time consuming to apply for, right through to some of the more accessible options around whether it's revenue-based finance, inventory finance, invoice finance. But a lot of these solutions, I'd say, just from what we've seen from the customers that we support and work with, they don't really align with the business's needs. And often it can be a combination of accessibility, the application process, still quite old school, so offline back and forth. Sometimes the actual structures, the repayment structures, the term, they can be very expensive. All these things don't really align with business needs. So we've tried to address all of those things with what we've launched.